Welcome to the deep dive. Okay, so we've got the materials from that Q3 2025 earnings call for, well, a major player in industrial gases. And this one, it's a bit of a head scratcher, isn't it?
It really is. You look at the numbers, and management just delivered. Record operations, margins expanding, cash flow is fantastic, everything you'd want to see operationally.
But then the market reaction was, well, not great, cautious, even negative.
Exactly. That's the puzzle. So our job here is to dig into why. Is this just short-term jitters about the economy, maybe some guidance worries, overshadowing what looks like a really solid long-term setup?
Right. We need to unpack the results, figure out what management's actually saying about this industrial recession they keep mentioning, and see if that underlying strength is maybe being missed.
Let's do it, because those headline numbers, they deserve a look first.
Okay, so the big one, adjusted earnings per share, EPS, a record $4.21. That was actually 3 cents better than the consensus, which sat around $4.18.
Yeah, a solid beat on EPS. Revenue was, well, pretty much exactly what everyone expected, $8.62 billion.
Yeah.
Right in line.
So no surprises on the top line, but they found a way to beat on the bottom line. How?
Well, this is interesting. Total revenue year over year was up 3%,
Okay.
but the underlying sales growth, only 2%.
And that 2%.
Purely price increases. 2% price lift. Overall volumes were actually flat compared to last year.
Wow. So zero volume growth, but they still grew the top line slightly and beat on earnings. That points to some serious operational control.
Absolutely nailing it on discipline. Their adjusted operating margin, get this, went up 10 basis points year over year, almost 30%, 29.7%.
That's impressive when you're not getting any help from selling more stuff.
It really is. They're just squeezing more profit out of every dollar.
Yeah.
And that flows right down to cash.
Yeah.
Operating cash flow, OCF, jumped 8% compared to last year. Nearly $3 billion, $2.95 billion.
Generating how much free cash?
$1.67 billion in free cash flow for the quarter. I mean, the cash generation is just humming along, setting records.
Okay, so record EPS, record cash flow, managing costs incredibly well. Which brings us back to the question, why the long faces in the market?
Yeah, here's the rub. It boils down to the guidance for the next quarter, for Q4. Management put out an adjusted EPS range of $4.10 to $4.20.
Which is below what the analysts were expecting.
Just slightly. The street was looking for something like $4.23. So guiding below that, even if it includes a bit of help from currency, like a 2% FX tailwind they mentioned, it implies things might slow down a little sequentially.
And investors hate seeing any kind of potential slowdown, even a slight one.
Precisely. That guidance, even though the full year forecast still looks okay, they're guiding $16.35 to $16.45 for the full year. That's still 5% to 6% growth year over year.
Which is decent, resilient growth.
It is. But that Q4 number, that slight miss versus expectations, it just seemed to overshadow the bigger picture for some people.
Let's talk about that bigger picture then, the macro environment. Management was pretty blunt, weren't they? The CEO basically said they've been dealing with an industrial recession for, what, over 2 years now?
Yeah, quite a statement. But they also said their whole business model is built to be recession resistant.
What does that actually mean in practice?
Well, they described this kind of three-part engine for EPS growth. Think of it as management actions, cost cutting, efficiency, that kind of thing. That's one engine.
Okay.
Then there's capital allocation, buybacks, dividends, smart investments. That's engine 2. They expect both of those engines to contribute, like mid-single digits growth each, regardless of the economy.
So even if the third engine, the macro environment, is actually dragging things down.
Exactly. Even if the macro is a headwind, the first two engines are strong enough to keep delivering growth. That's the theory anyway. And honestly, given the flat volumes and record earnings, it seems to be working.
But that macro drag isn't hitting everywhere equally, right? The regional performance was really uneven.
Oh, yeah, the Americas are still looking strong. Underlying sales, they're up 4%. That was mostly price, 3% price, but they did get a little 1% volume lift too.
So still some life in the Americas, but elsewhere.
Yeah, that's where the weakness is concentrated. Asia Pacific, APAC, underlying sales actually dipped slightly, down 1%.
And Europe, EMEA.
That's still the problem child. Volumes down 3% year over year, just ongoing softness in industrial activity there. And management was pretty clear. They don't see that changing quickly. They expect that weakness to stick around.
Okay, let's drill down into the specific industries, the end markets. Electronics seem to be the big bright spot.
Absolutely. Fastest growing segment, up 6% year over year. And this is where their long-term story really kicks in.
How so?
Management isn't seeing this as just a temporary blip. They think we're in a multi-year cycle, maybe 5, even 7 years, driven by massive investments in high-end semiconductor manufacturing. Think Korea, Taiwan, the US, building these new advanced chip fabs.
And these advanced nodes, the really tiny, powerful chips for AI and stuff, they need more gas to make.
Way more gas, much higher gas intensity, as they call it. So every new fab that comes online using these advanced processes means a significant jump in demand for their specialized gases. It's a built-in growth driver for years to come.
Okay, that makes sense. What about manufacturing? That was up 3% year over year.
Yeah, surprisingly resilient, especially in the US. And they call out something interesting strength in commercial space. Apparently, rocket fuel and satellite propulsion is a noticeable growth area for them.
Didn't see that coming.
Me neither. And another positive sign they mentioned, they're seeing increased sales of automation equipment to their manufacturing customers, which suggests those customers might be getting ready for, a future pickup, maybe in auto production or elsewhere, even if things are slow now.
Right, investing ahead of the curve. But then there's chemicals and energy.
Yeah, that's weaker. Volumes are kind of flat or down globally, and again, Europe is the weakest spot there. But here's where that recession or resistant model comes back in.
The contracts.
Exactly. They have these long-term contracts, often with take-or-pay clauses. That means the customer has to pay for a minimum amount of gas, whether they use it all or not. So even if a chemical plant slows down production, the company's revenue stream is largely protected.
It's like signing a lease. You pay the rent even if you don't use the space every day.
That's a great analogy. It provides really important profit insulation, especially when volumes get choppy like they are now.
But it wasn't all smooth sailing. They did mention a specific drag from pricing pressure in certain areas.
Yeah, good point. While overall pricing was up 2%, they specifically flagged helium and rare gases. Seems there's just too much supply globally right now, and that's hitting prices, especially impacting the Asia Pacific region.
And that wasn't insignificant?
No, they estimated it shaved maybe 1% to 2% off their total year-over-year EPS growth. So imagine the beat if that hadn't happened. It shows even they aren't immune to specific market imbalances.
Okay, so that connects back to the whole macro picture. But let's shift to the part investors seem to be, maybe ignoring the backlog.
Yes, the backlog. They're sitting on a record $7.1 billion in sale of gas projects. This isn't pie-in-the-sky stuff. These are signed contracts for future plants and supply agreements.
$7.1 billion, and they're spending to build these out.
Big time. They've budgeted $5 to $5.5 billion in capital expenditures, CapEx, largely to fund building these projects.
Yeah.
And they sounded really confident they can keep that backlog number around $7 billion, even though they're bringing about $1 billion worth of projects online this year alone.
So this backlog, it gives them visibility for years outright, locked in revenue, probably with inflation protection built in. It kind of insulates them from the day-to-day swings in the economy.
It's their biggest shock absorber. They are literally constructing their growth for the next 5, 10 years right now. And think about the capital situation too. They've already returned $5.3 billion to shareholders this year through dividends and buybacks.
And the balance sheet is still strong.
Very strong. They described it as under-leveraged. They have plenty of firepower. It's a picture of just extreme financial health.
Which makes the stock performance even more puzzling. You said it's basically flat over the past year.
Pretty much. Meanwhile, the S&P 500 is up, almost 20%?
Yeah.
Even the materials sector ETF, the XLB, which you'd think would be feeling similar pressures, is only down maybe 4-6% in the last year. So this stock is definitely lagged behind.
It just doesn't seem to add up. All this operational strength, the backlog, the cash return, and the stock's treading water.
And that brings us right back to the core debate for anyone looking at this. Are you going to focus on the Q4 guidance hiccup and the ongoing but seemingly stable weakness in Europe? Or do you look past that to the huge contracted growth pipeline, that electronics boom, the potential in hydrogen and decarbonization down the road?
Because if sentiment shifts or Europe stabilizes or one of those big hydrogen projects gets announced,
you could see a major re-rating of the stock. The potential seems there, but the market's clearly cautious right now.
Okay, let's move to our favorite segment. This is not financial advice, based purely on everything we've just discussed from the calls. What's an outrageous but maybe plausible trade idea here?
All right, disclaimer firmly in place. This isn't advice. But the idea stems from that core tension we identified. You've got arguably best-in-class execution, a fortress balance sheet, and this massive backlog.
The best house in a bad neighborhood idea.
Exactly. Record EPS despite the industrial recession, deploying cash smartly. That's $7.1 billion safety net. Yet the stock's lagging its peers and the market.
So you want to play that divergence. Superior quality versus the struggling sector.
Right. So the trade could be something like go long the stock itself, betting on its specific strengths and insulation, and fund that by going short the broader materials sector ETF, the XLB.
Why short the XLB specifically?
Because the XLB hold a whole basket of materials companies. Most of them likely don't have the same level of long-term contracts, the take-or-pay structures, or the specific exposure to growth areas like advanced electronics that this company does. They're more exposed to the general industrial cycle.
Okay, so long the specific quality, short the general sector exposure. What's the thinking if things get worse or better?
Well, if the industrial recession deepens, the thesis is the long position holds up better than the basket because of its contracts and discipline, while the short XLB provides a hedge against that macro downturn. But if the macro environment actually starts to improve,
then the long position should really take off.
that's the bet. With that huge backlog ready to activate and its strong market positions, it should theoretically outperform the broader, more commoditized basket in a recovery, leading to gains on both sides of the relative value trade. It's purely a bet on superior execution and contractual strength winning out over time.
Interesting. Definitely puts the call's contradictions into a potential strategy. So wrapping up, the core tension remains. That fantastic $4.21 EPS beat right up against a cautious Q4 outlook and ongoing European concerns.
And the big question for you listening is probably this. Management sounds incredibly confident about that 5 to 7 year electronics cycle. They're clearly positioned for hydrogen and decarbonization with that huge backlog. So is the market maybe getting too caught up in near-term stuff like Q4 tax timing or FX moves and missing the bigger picture, missing the compounding power of that $7.1 billion backlog?
That's the key question to mull over as you look at the industrial space. Thanks for joining us for this deep dive into these earnings call insights. We'll catch you next time.